How's it going, guys? I want to show you how to spot reversals using the chart for Dare Bioscience. This is the chart for this past Monday, which was January the 13th, 2020. And this is pretty easy to spot to me. And I want to show you guys how to see the same thing that I see and to be able to make a profit on charts that look like this in the future, which this is a pretty common chart. So if you can grasp this, and I'm going to try to break it down in the simplest terms as possible. If you can grab this understanding and see how the logic flows within trading this, you will be able to see this thing for yourself and then make trades like this in the future. So I like to trade with logic. Basically, a lot of people buy and they enter into a trade and then they hope that the price goes up, and they don't have any clear understanding of where to sell. They know that they bought in and they know their average price, or they should know their entry price, but they're kind of holding and hoping rather than holding and knowing exactly where to sell. There's a phrase: you want to plan your trade and trade your plan. You want to know your stop loss limit and your take profit target before you enter a trade. So this is how we're going to find that information out, and how we can do so in a very simple way. So in the pre-market, what we notice here is the price goes up from 83 cents to $2.53, and then it starts to lose momentum towards the opening. So basically at the opening, the price drops from $2.53 to $1.58. So with that in mind, what you'll notice here is we have a sudden rise in price, and then we have a loss of momentum on a downtrend. So at the bottom of a downtrend, what we can see here is this green candle right here. That's a hammer candle for those of you who don't follow the types of candle formations and patterns. This right here is known as a hammer candle. So a hammer candle is a very bullish candle, especially when it is at the bottom of a downtrend. So that makes a big difference, because if you trade based on the fact that you see a hammer candle, and you buy in on that candle, the very next candle formation could be lower, and the downtrend can continue. And you don't want to be in that situation, because you're going to lose money. Even if you set a high stop loss, you're going to lose something, and it's not going to be a profitable event for you. So what you see here, here's an example of that. Here's a hammer candle. It's an even bigger one than this one. So the size of the candle doesn't really matter in this instance. So if you were to buy in the pre-market on this hammer candle, your price would have lost a lot of money there by the time the market opened. So the difference between this hammer candle and that hammer candle is that this is at the bottom of a substantially long downtrend, and the biggest factor is that volume backs the candle. If you notice this one, there's not much volume that backs that candle. This one right here, there's down, you can see it's about 10 million shares, 10 million volume right here on that candle. So that right there is a very bullish signal, and that's a strong signal to and a good place to enter your trade with confidence. So if you look at volume on other locations of this chart, even going back into December, there's no volume amount that's like this one right here. There's nothing comparable anywhere in this chart. So that's a key thing to understand. So it's a certainty at this point when you see the volume backing a bullish hammer candle at the bottom of a downtrend. That's a certainty that the price is going to rise. A reversal is going to take place, and the downtrend is going to come to an end. So the bullish momentum has stopped at this point, and the bearish momentum has stopped at this point, and the bullish momentum has picked up. So in real life, you can't see in the future, so we're going to cover this up right here, and we're going to make an assumption here that that you entered this trade right here at this candle. Let's assume you saw the volume, and you saw the hammer candle, and you entered somewhere in between, let's say $1.60 to $1.75. Let's say it was $1.70 was your entry. With that in mind, now that you've entered at $1.70, you need to know where you're going to sell at. So the key principle in trading that we've all heard time and time again is that you buy low and you sell high. So that's the same thing as saying that you buy at support and you sell at resistance. So you don't want to buy and hope. You don't want to buy and then once you're in the trade, you're hoping that the price is going to go up, and when it does, that's when you sell, because that's illogical. There's no understanding and expertise behind that type of trading. You're treating the stock market like a casino, and you need to not trade if that's how you trade. If that's how you trade, you need to do more paper trading. You need to find simulators. You need to take some courses on technical analysis, because you're going to lose money doing things that way. And I don't like to see that type of thing happen. So basically, once you enter a trade, you need to know where you're going to sell. And how you do that is, before you enter the trade, is you find key resistance levels. So the first key resistance level is going to be right here at 253. So if for some reason we see this candle right here, if it gets up to that, we know that we want to sell at that point. We don't want to wait for it to, we don't want to see if it goes beyond this level. We want to sell at this level. So but the likelihood that the next candle, or the next two candles, or probably the next three candles, are going to come all the way up to this level, that's really high hopes right there, and there's no reason to believe that would happen. So what you want to do is you want to look at other areas of resistance in this chart. So doing that, we want to find another resistance, another more realistic resistance to sell at. Not that the $2.53 resistance isn't realistic. We just know that we probably want to sell before the price rises that high, because there's no guarantee that the price will rise that high. So if we take this line and we bring it down, let's say the general rule of thumb is that stocks, they usually retrace in 50% increments. So if this is 0% and then this is 100%, then we kind of want to look for a resistance around here, that's kind of 50%. You don't have to be perfect. you just kind of want to put your line there. And what you want to do once your line is there is you want to see some candles on this end that seem like a resistance area where multiple candles touch this line. So if we just kind of leave this here, we don't really see much. But what I would say is let's start with that. So the volume is definitely going to pick this price up, and it's definitely going to the next 5 or 6 candles are going to be higher than this hammer candle right here. So how high do we think it's going to go? Let's move one candle into the future. So now we see that it touched this resistance level. So that is close to 50%. So what I would say is if you entered anywhere between 160 and 175, and then 5 minutes later you see the price go to $1.92, that's going to be a good area to sell. So when you think about that, the difference between $1.75 and $1.92, that's like a 20% or a 20-cent price rise. So that's very considerable. That will give you a 2-to-1 risk-reward ratio if you think about that. Because basically if you set your stop loss, let's say if you enter at 170 and you set your stop loss at 167, you can kind of see the that 192 is significant. So that's worth trading, in my opinion. That's a trade worth entering because it's going to give you a return, and you're not going to be entering and then selling 5 cents later, because if the price is only going to go up, if you're anticipating the price to only go up about 5 cents, then you kind of don't really want to enter that trade, because there's better trades. There's thousands of stocks, and there's better trades to choose from than to try to make money on a 5% a 5 cent price shift. So we see that this resistance line is touched on the very next candle. So I say that's a win. That's a win right there. We looked at this resistance level. We saw 1, 2, 3 candles touching it, and it kind of teeters off down here, or and comes down towards the open. But that's going to give you your 2-to-1 advantage right here. And the fact that you're buying here on heavy volume at the bottom of a downtrend with a hammer candle, that's high probability. So that's what you want to see when you're day trading. That's what you want to see. So if we continue in this and look more into the future, we see that this level of resistance is broken. So basically you can argue that if you bought here at 170 and you sold and you didn't sell and you held, you would eventually had an opportunity to sell at $2.10, which that's true. You can definitely hold all you want. There's other strategies that you could apply to this same reversal setup. You can raise your stop loss incrementally, and if the price goes down, you can still walk away with a profit. But basically, that's this right here is worth trading. If you look into the future, you can kind of see that the price gets stuck in a range a little bit over here. So you don't want to be holding through that, because honestly, if you're holding through this right here as a day trader, you're not being logical. You're hoping that the price goes up. Even if you raise your stop loss and kind of set it up over here, you want to enter trades on your own initiative, and you want to exit trades on your own initiative, and that putting a stop loss while you're stuck in a range, that would be exiting on your own initiative technically, but you don't typically want to trade in ranges because you don't know what's going to happen, and the longer the range goes on, that's the longer time you're going to be in this trade. That's more time that's going to eat up in your day. You could be looking at other trades. Something else could be popping at this time where you're just kind of like not making money, because you're not making money right here. If you're holding right here, the price may be going up in between like 3, let's say 5 cent tops. You're not gonna see it jump 10, 20 cents. Over here you did. Over here you saw it jump. If you entered, let's even assume that you entered at $1.75. If over here the very next candle, if you entered at $1.75, you would have the opportunity to sell at $1.92. So that's close to 20 cents right there, and that's an easy win. So you're not trading in a range at that point. You're trading with momentum. That's momentum right there, going from $1.75 high to $1.92 high, and that gives you plenty of time too. So this is 10 minutes. That's a 5-minute candle. This is a 5-minute candle. So you can pick and choose. It's not a rush at that point, because 10 minutes is kind of a while for you to decide if you're going to keep it or not. You could trail your stop loss at that point, and decide to either get stopped out, or if you really wanted to, you could have held over here. Would have came, if you entered at 170, it would have came back to that price. So I don't like that. I don't want to see it come back from a 20 cent pickup to back down to my entry price, and I'm still in the trade. And that's, you can break even and you're not going to lose money if you set your stop loss up high during that time, or raise it during that time, but it's not gonna, you're gonna feel crappy because you missed out on a lot of profit. So I would have bought in here at 175, and I would have sold in here, let's say at like 185 even. Let's say you didn't do this perfectly and you missed the 192, you got greedy, it went down to 185. That's a 10-cent shift. That's a 10-cent price rise. That even is a decent pickup. So especially if you set your stop loss to around 165, 167, you're going to get a decent profit, or a decent risk reward versus risk trading on that setup. So again, in terms of high probability trades, you want to look for multiple factors in order to enter a trade. You want to see multiple reasons that give you a clear indication that the trade is worth entering. So how many indicators do we have right here? We have one. That's a hammer candle at the bottom of a downtrend. So that's one indicator. And then we have a second indication right here with the volume following up that hammer candle. And the volume is not just following this candle and pushing the price up, but it's also bigger volume than any of the other volumes that we can see here. So that's two really good factors to enter that trade. So if you feel this video has helped you and benefited you in any way, please like, share, and subscribe, and thank you for watching.